Something happened in America in 1983 that most retirees have never been told about. Not in school, not by their financial advisor, not by the smiling representative on the Social Security hotline, not by the cable TV personal finance host who spent 20 years telling you to max out your 401k. Something was quietly built into the American retirement system, a mathematical trap, engineered with surgical precision, designed to look completely invisible until the exact moment it snaps shut around your ankles. And that moment, for millions of hardworking Americans, is the day they file for Social Security. You spent 40 years doing everything right. You saved, you sacrificed. You delayed gratification in ways that would make your younger self genuinely proud. And now at the finish line, the IRS is legally positioned to walk up to your mailbox, reach inside your Social Security check, and pull out 85 cents of every dollar before you ever see it. Not because you did something wrong, not because you cheated, but because nobody told you which 4 accounts to empty before you filed. This is that conversation. Here's the uncomfortable truth that the retirement industry does not want to become a viral video. The Social Security system, as it exists on the books in 2026, contains a taxation mechanism so quietly devastating, so deliberately obscured from public understanding, that financial researchers have started calling it the greatest stealth tax in American history. And unlike most financial dangers that only affect the wealthy or the reckless, this one was specifically, mathematically, almost surgically designed to hit the people who did everything correctly. The disciplined savers, the people who maxed out their employer match, the people who drove the old car, skipped the vacation, and put the difference into a traditional 401k because every personal finance voice in the room told them that was the smart move. Those are the people this trap was built for. And in 2026, it is collecting more victims than at any point in the 4 decades since it was constructed. To understand the scale of what we're dealing with, you need to understand a formula. It's called provisional income, and it is the engine that drives this entire tax mechanism. The IRS calculates your provisional income by taking half of your annual Social Security benefit and adding it to every other source of income you have coming in. That includes wages if you're still working. It includes withdrawals from your traditional 401k. It includes withdrawals from your traditional IRA. It includes pension payments. It includes interest income from CDs and high-yield savings accounts. It includes capital gains from your taxable brokerage account. It includes dividends, both qualified and non-qualified. It includes rental income. And then it includes something that will genuinely shock most retirees when they hear it for the first time. It also includes tax-exempt municipal bond interest. The interest that your broker told you was completely tax-free. The interest you specifically chose municipal bonds to generate because you wanted to avoid exactly this kind of tax exposure. The IRS folds that interest directly back into your provisional income calculation, every dollar of it. This is why retirees are constantly blindsided. People assume that tax-exempt income should stay invisible for this particular test, but the Social Security worksheet brings it back into the combined income calculation regardless of its source. So the muni bond strategy that an entire generation of retirees was sold as a safe harbor from taxation, it doesn't protect you from Social Security taxation at all. It is, in the most technically legal sense possible, a trap inside a trap. Now, once your provisional income is calculated, it gets measured against thresholds. And this is where the story gets genuinely infuriating. The thresholds in 2026 remain exactly where they were set in 1984. For single filers, Social Security benefits become taxable when provisional income exceeds $25,000, with up to 50% taxable between $25,000 and $34,000, and up to 85% taxable above $34,000. For married couples filing jointly, the lower threshold is $32,000 and the upper threshold is $44,000. These thresholds have not been adjusted for inflation since the day they were written into law, not once, not by a single penny. Think about what that actually means in real human terms. Think about what $32,000 represented to a married couple living in America in 1984. It was a comfortable lower middle class income. You could pay a mortgage, you could run a car, you could put food on the table and have a little left over. In 2026, $32,000 does not cover a full year of Medicare premiums, supplemental drug coverage, basic groceries, property taxes on a paid-off home, and one round-trip flight to visit your grandchildren. $32,000 in 2026 is not wealth. By every measurable economic standard, it is barely functional survival income. But to the IRS, the moment a retired married couple's provisional income crosses $32,000, they are wealthy enough to have their Social Security taxed. And when it crosses $44,000, they lose 85% of their benefit to the federal government's calculation. Because these thresholds have never been indexed to inflation, more retirees fall into taxable ranges every single year, without Congress ever having to cast a single vote to raise anyone's taxes. The inflation does the legislative work. Every year that goes by, every cost of living adjustment that Social Security issues, every dollar of interest income generated by a CD account, every forced withdrawal from a traditional IRA under the required minimum distribution rules, all of it quietly pushes more and more retirees across a threshold that was already designed to be too low. This is bracket creep weaponized. This is a tax increase that never has to be voted on because it was engineered to grow automatically. And it has been growing silently since Ronald Reagan signed it into law. Now let's talk about the 4 accounts, because this is where the actionable intelligence lives. This is where the difference between a retiree who pays the IRS thousands of dollars per year that they didn't have to pay, and a retiree who legally owes the federal government approximately nothing, comes down to a series of decisions that most people make without understanding the consequences. The 4 accounts are the traditional 401k, the traditional IRA, the high-yield CD or savings account, and the taxable brokerage account filled with dividend-paying positions. Every single one of them feeds your provisional income calculation. Every single one of them can drag your Social Security benefits into the 85% taxation zone. And every single one of them can be neutralized before you file, if you understand how the system actually works. The first toxic account is the traditional 401k. This is the account that the American personal finance industry spent 4 decades building a cultural religion around. Max it out. Take the employer match. Let it grow tax deferred. The pitch was always presented as a gift. The reality is considerably more complicated. Every dollar you contributed went in pre-tax, which felt like a benefit in the years you were working because it reduced your taxable income in high-earning years. But every single dollar that comes out the other side is taxed as ordinary income. Not at the lower capital gains rate, not partially tax-free, fully, completely, 100% ordinary income. And in the context of the Social Security taxation formula, every dollar that comes out of your traditional 401k gets counted in your provisional income calculation. So if you're pulling $40,000 per year out of your 401k to cover living expenses in retirement, that $40,000 is pushing your provisional income dramatically higher, likely across both Social Security taxation thresholds, and triggering the 85% rule on a benefit you spent 40 years paying into. The window between retirement and age 73, when required minimum distributions begin, is often the most valuable planning opportunity most retirees will ever have. Income typically drops significantly after leaving the workforce. Social Security may not have started yet. This creates a temporary alignment where tax brackets can be filled intentionally rather than passively triggered by forced withdrawals. This is the Roth conversion window. And it is the single most powerful financial tool available to pre-retirees and newly retired Americans who want to legally dismantle this trap before it closes permanently. The strategy works like this. In the years between when you stop working and when you claim Social Security, your taxable income is often at its lowest point in your entire adult life. You have no wages. You may have no Social Security income yet if you're delaying to maximize your benefit. You have minimal required distributions because those don't begin until 73 under current law and 75 for those born in 1960 or later. This creates a narrow window, sometimes as long as a decade depending on when you retire, during which you can convert money from your traditional 401k or traditional IRA into a Roth IRA, pay the income tax on the converted amount at these historically low personal rates, and then permanently remove that money from the provisional income calculation for the rest of your life. The One Big Beautiful Bill Act, signed in 2025, permanently extended the tax rate structure from the 2017 Tax Cuts and Jobs Act, which means the 10%, 12%, 22%, 24%, 32%, 35%, and 37% brackets are no longer scheduled to sunset. The urgency narrative about converting before rates go up federally has shifted, but the personal urgency has not, because RMDs will force withdrawals at higher brackets whether federal rates change or not. In 2026, for a married couple filing jointly, the standard deduction is $32,200. The 22% bracket runs up to $100,800 of taxable income, and the 24% bracket extends to $211,400. With no wages and no Social Security yet, a couple can convert roughly $240,000 per year and still keep their taxable income within the 22% bracket. At that pace, a $1.4 million traditional account can be fully converted in approximately 6 to 7 years, well within the pre-RMD planning window. The math on this is not abstract. It is the difference between paying a predictable, controllable tax rate during the conversion years and being forced to pay a higher, unpredictable rate later when RMDs are mandatory. Social Security is fully in payment, and the IRS is the one setting the withdrawal floor, not you. The second toxic account is the traditional IRA. The mechanics are identical to the 401k in terms of how it poisons your provisional income calculation. Every withdrawal is ordinary income. Every withdrawal counts toward the threshold. Every dollar forced out by required minimum distributions is a dollar that potentially triggers Social Security taxation you cannot avoid once the RMDs begin. The increase in the RMD age under the Secure Act 2.0 has created a defined planning window between retirement and age 73, where income levels can be managed with greater precision. During this phase, individuals often experience reduced earned income while not yet being subject to mandatory withdrawals, creating a temporary alignment where tax brackets can be used intentionally rather than passively triggered. The conversion strategy is identical. Move money from your traditional IRA into a Roth IRA in annual increments designed to fill the lower tax brackets without spilling into the next tier. And there is a critical additional benefit that most retirees don't calculate. Roth IRAs have no required minimum distributions for the original account owner. 0. The IRS cannot force you to take a single dollar out of a Roth IRA during your lifetime, which means that if you successfully convert your traditional IRA into a Roth before age 73, you have permanently eliminated the forced withdrawal mechanism that was going to drive your provisional income into the 85% zone for the rest of your life. There is one important technical detail to understand about Roth conversions that could cost you significantly if you get the timing wrong. Each Roth conversion starts a 5-year holding period that begins on January 1st of the conversion year, not the actual date of the conversion. For individuals under age 59 and a half, withdrawals of converted funds before the 5 years are complete may be subject to penalty. When multiple conversions are executed over consecutive years, each carries its own 5-year timeline, creating a staggered access structure rather than a single liquidity point. This is not a reason to avoid conversions. It is simply a reason to plan them carefully with awareness of your cash flow needs during the conversion years. There's also another timing trap that sits inside the Roth conversion strategy that sophisticated planners are now building their entire approach around. Conversions must account for Medicare's 2-year IRMA lookback. The income reported in a conversion year gets used to set Medicare Part B and Part D premiums 2 years later. This means conversions that seem bracket safe today can manufacture significant Medicare premium increases when coverage begins, particularly around age 65. In 2026, IRMA surcharges begin at $109,000 MAGI for single filers and $218,000 for joint filers, climbing in 5 tiers from there. A single high conversion year can generate an extra $4,000 to $9,000 in Medicare premiums 2 years after the fact. This is not a reason to stop converting. It is a reason to be precise about the annual conversion amount and to plan the timing in relationship to your Medicare enrollment date, not just your tax bracket. The third toxic account is the high-yield CD and savings account. And this one catches retirees completely off guard because it feels like the safest, most responsible thing in the room. You walk into the bank, the teller smiles. There's a special on an 18-month CD at 4.6%. You put your cash in because you want safety and you want yield, and both of those desires are completely rational. But every year, the interest that CD generates, whether you spend it or not, shows up on a 1099 INT and gets added to your ordinary income and to your provisional income. CD interest is not taxed at the lower long-term capital gains rate. It is taxed as ordinary income, and it absolutely counts toward the Social Security taxation thresholds. A retiree with $100,000 in high-yield CDs at current rates is generating roughly $4,000 to $5,000 per year in interest income that could be pushing them across the $32,000 married threshold or keeping them firmly in the 85% zone when they were already close to the edge. The interest doesn't have to be large to be damaging. In the provisional income calculation, where the thresholds are so low and so frozen in time, even a few $1,000s of interest income can mean thousands of dollars in Social Security benefits becoming taxable. The fix for the CD problem involves repositioning cash that isn't needed for immediate liquidity into vehicles that defer taxable events rather than generating annual 1099 income. A non-qualified deferred annuity accumulates interest on a tax-deferred basis without generating annual income statements while the money is in accumulation mode. I-bonds allow you to defer the federal tax on interest until redemption, giving you control over which tax year the income appears in, and any cash that can legitimately move into a Roth IRA through either a direct contribution, if you have earned income, or as part of a broader conversion strategy, permanently removes the interest-generating capacity from the taxable universe. The goal is to stop manufacturing provisional income in years when your Social Security benefits are active and your income is being measured against thresholds that haven't moved since the Reagan administration. The fourth toxic account is the taxable brokerage account, and this is where the trap gets genuinely sophisticated. Most retirees look at their brokerage account and think about tax liability only in terms of selling. They believe that as long as they hold their positions and don't sell, they are not generating a taxable event. This is partially true and dangerously incomplete. If your taxable brokerage holds dividend-paying stocks, mutual funds, or ETFs, those positions are generating 1099 DIV income every single year, regardless of whether you reinvest the dividends or not. And every dollar of that dividend income, even the qualified dividends that are taxed at the lower capital gains rate, counts toward your provisional income calculation. The IRS does not distinguish between types of income for the purpose of determining whether your Social Security benefits are taxable. A dollar of dividend income and a dollar of 401k withdrawal are equally devastating to your provisional income number. It gets worse with actively managed mutual funds. Those funds can throw off capital gain distributions in years when you never sold a single share, because the fund manager sold holdings inside the fund, and those gains flow through to every shareholder as a taxable distribution. You did nothing. You made no decision to sell. You had no control over the timing, but the distribution appears on your tax return, increases your provisional income, and potentially pushes more of your Social Security into the taxable zone. This is a hidden fee that the fund industry does not advertise, and that most retirees never fully understand until they're sitting across from their accountant in February, wondering why their tax bill is larger than they expected. The solution to the taxable brokerage problem is called asset location. The concept is straightforward, even if the execution requires planning. Your most tax-inefficient assets, meaning your high dividend funds, your actively managed funds that generate capital gain distributions, your bond funds, your real estate investment trusts, belong inside your Roth IRA, where all of their income compounds, completely free of taxation and completely invisible to the provisional income calculation. Your most tax-efficient assets, meaning your broad market index ETFs that generate minimal dividends and virtually no capital gain distributions, are better positioned in your taxable brokerage where their tax drag is minimal. Moving assets between accounts through a conversion or repositioning strategy can dramatically reduce the annual taxable income that your investment portfolio generates, which in turn can dramatically reduce your provisional income, which in turn can legally reduce or completely eliminate the taxation of your Social Security benefits. There is also a strategy for retirees who are charitably inclined that delivers a double benefit in this context. A qualified charitable distribution, or QCD, allows individuals who are 70 and a half or older to direct up to $108,000 per year from a traditional IRA directly to a qualified charity. And that distribution does not count as ordinary income on your tax return. It satisfies your required minimum distribution obligation without adding to your adjusted gross income, which means it does not count toward your provisional income. A retiree who is charitably inclined and strategically uses QCDs instead of taking cash, RMDs, and then writing a check to charity can potentially reduce their provisional income by thousands of dollars per year, keeping more of their Social Security benefit below the taxation thresholds. Now let's make this concrete with actual numbers, because abstract concepts only become real when you run them through a specific scenario. Consider a married couple, both 68 years old, living in a state with no income tax. Together, they receive $44,000 per year from Social Security. To cover their living expenses, they pull $42,000 per year from a traditional 401k. Their provisional income calculation looks like this. Half of their Social Security, which is $22,000, plus their $42,000 traditional 401k withdrawal, equals $64,000 of provisional income. They are $20,000 above the $44,000 married threshold. The IRS applies the 85% rule. Approximately $30,000 of their Social Security becomes federally taxable income. Add that to their $42,401k withdrawal, subtract the 2026 standard deduction for a married couple both over 65, and they have a meaningful federal tax liability on income they thought was going to fund their retirement in dignity. Now run the exact same couple through a different scenario. They did Roth conversions during the 5 years between retirement and their claiming date. They converted enough of their traditional 401k into a Roth to cover their living expenses. Now they pull $42,000 per year from the Roth IRA. Roth withdrawals do not count as ordinary income. Roth withdrawals do not enter the provisional income calculation. Their provisional income is now simply half of their Social Security benefit, which is $22,000. That is $10,000 below the $32,000 married lower threshold. 0% of their Social Security is taxable. Their federal tax bill for the year is functionally zero after the standard deduction. Same couple, same lifestyle, same amount of money being spent. One version gives the federal government thousands of dollars per year that it was never legally required to take. The other version keeps that money inside the family. Over a multi-year retirement, properly timed Roth conversions and provisional income management can generate lifetime tax savings exceeding $185,000 for a couple with a substantial traditional IRA balance. The strategic roadmap for neutralizing this trap has a clear sequence of steps, and the sequence matters as much as the individual actions. The first step is to calculate your current projected provisional income with brutal honesty. Pull your most recent Social Security statement. Pull every account statement you have. Add up every income source that counts toward the formula and determine whether you are already above the thresholds or in danger of crossing them the moment Social Security begins. Most retirees who go through this exercise for the first time discover that they are in worse shape than they realized, because nobody walked them through the calculation before now. The second step is to identify your conversion window. If you retire at 62 and required minimum distributions start at 73, you have an 11-year conversion window during which Social Security, pension income, and RMDs are not yet stacking on top of each other. This is the most tax-efficient period most retirees will ever experience, and every year that passes without using it is bracket space permanently lost. The calculation starts with your taxable income from all non-conversion sources, including any wages, pensions, or investment income, and the conversion fills whatever bracket space remains up to the desired ceiling. In 2026, for most pre-Social Security retirees, the target is to fill the 12% bracket completely before moving into the 22% bracket. For married couples filing jointly, the 2026 standard deduction is $32,200, and couples where both spouses are 65 or older may claim an additional $650 per spouse. A retired couple with no wages and no Social Security can potentially convert substantial amounts before their effective tax rate exceeds 12%. The fourth step is to address the CD and savings account problem before Social Security starts, not after, before. Every year that you hold interest-bearing accounts in a taxable environment during your Social Security years is a year that interest income is counting against you in the provisional income formula. The repositioning should happen during the same window as your Roth conversions, coordinated so that you're reducing taxable interest income and reducing traditional account balances simultaneously. The combination of those two moves can shift your provisional income by more than you would expect. The fifth step is asset location in your taxable brokerage. Review every holding in your taxable account and ask a simple question. Is this position generating annual taxable income in the form of dividends or distributions? If the answer is yes, and especially if that income is being reinvested rather than spent, you are paying a provisional income price for a benefit you're not even receiving in cash. Repositioning high dividend positions into your Roth IRA, where the same yield compounds without tax consequence, can reduce your annual provisional income while keeping your total investment return identical. The sixth step is to consider delaying Social Security if you have not yet claimed. The window between retirement and age 73, when RMDs begin, is the most tax-efficient period most people will ever have. It should be treated as a conversion opportunity of the highest priority, not as idle time waiting for the check to start. Every year you delay claiming Social Security between your full retirement age and 70 increases your monthly benefit by 8% per year through delayed retirement credits. The combination of a higher monthly benefit and a more completely converted Roth account means you arrive at claiming with a larger check and a smaller provisional income bomb waiting to detonate. The seventh step is to set up voluntary federal tax withholding on your Social Security benefit by filing a W-4V with the Social Security Administration. The available withholding rates are 7%, 10%, 12%, and 22%. If you're in a situation where some of your benefits will be taxable despite your planning, having the tax withheld at the source eliminates the April ambush of a tax bill you weren't expecting and weren't budgeted for. This is not a strategy to reduce your tax. It is a cash flow management tool to ensure the tax doesn't arrive as a surprise. What you are looking at when you step back and survey this entire landscape is a system that was built in 1983 with specific mathematical precision, that has been maintained without modification for 43 years, and that has functioned exactly as designed to transfer wealth from middle-class retirees who did everything right into the federal government's general revenue. The fixed dollar thresholds have not been indexed to inflation, which means the mechanism grows more powerful every year without any legislative action being required. Congress never has to vote to raise taxes on Social Security recipients. Inflation raises the taxes automatically. Cost of living adjustments to the benefit itself raise the taxes automatically. Every modest economic force that should be helping retirees keep up with the cost of living is simultaneously pushing them deeper into provisional income territory and deeper into the 85% taxation zone. The design is, from a policy engineering standpoint, elegant in a way that should make every retiree genuinely angry. In 2026, only 9 states tax Social Security benefits at the state level, and most offer income-based exemptions. But the federal mechanism applies to every American retiree regardless of where they live. The state tax question is secondary. The federal provisional income calculation is the primary battlefield, and it is the one that requires the most strategic attention and the earliest possible action. The conversation that needs to happen in America right now is not a conversation about whether Social Security is going bankrupt, or whether the trust fund will be depleted, or whether benefits will be cut in 2033 or 2035. Those are important questions, but they are future questions. The question that matters for retirees making decisions in 2026 is whether they understand that the money they are going to receive is already being taxed through a mechanism that most of them have never been explained, and whether they understand that the tax is not inevitable, it is avoidable, not through loopholes or aggressive tax shelters or anything that requires a team of expensive attorneys. It is avoidable through understanding a formula, knowing which accounts feed that formula, and making a series of planned, legal, documented financial decisions in the years before you file. The 4 accounts are not villains in isolation. A traditional 401k is a powerful savings vehicle. A traditional IRA is a legitimate retirement tool. A high-yield CD is a reasonable place for liquid cash. A taxable brokerage account full of dividend payers is a reasonable investment strategy. The problem is not any one of them in isolation. The problem is that all 4 of them simultaneously feed the provisional income calculation, and when you claim Social Security while holding significant balances in all 4, the cumulative effect is a tax bill that was entirely preventable. The goal is not to abandon these accounts. The goal is to transform them, convert them, reposition them in the years when the cost of doing so is lowest and the long-term benefit is greatest. And that window for most Americans is open right now. The people who will retire in comfort in 2026 and beyond are not necessarily the ones who saved the most. They are the ones who understood the system well enough to position their savings on the right side of a formula that is going to determine how much of their benefit they actually keep for the next 20 or 30 years. 1 formula, 4 accounts, 1 window of time to act. The math is not complicated. The knowledge gap is the only thing standing between you and a retirement where the IRS takes 85% of what you earned, or a retirement where they take nothing at all.